Hey everyone, welcome back. Before we dive in, don't forget to hit that like button and subscribe to the channel if you haven't already. Okay, so this week looks like it's going to be a busy one for U.S. financial markets with a bunch of stuff happening that could really shake things up.
Yeah, there's definitely a lot to cover, from President Trump's new tariffs to the upcoming inflation data and those corporate earnings coming out.
So let's kick things off with the trade situation. President Trump's announcing another round of tariffs on steel and aluminum imports. This time, it's hitting major exporters like Canada, Brazil, Mexico, even South Korea and Vietnam.
This is a pretty big deal because it kind of signals a return to those aggressive trade policies we saw a while back. You'll remember that during his first term, President Trump put similar tariffs in place, but eventually eased them for some of our allies. This time, though, it seems like everyone's getting hit.
And this is all happening while trade tensions with China are already pretty high, right? Both countries have already slapped tariffs on each other's goods.
Exactly, and that brings up the question of how these new tariffs will impact the global economy as a whole. Could this whole thing escalate into a full-blown trade war with multiple countries involved? A lot of analysts seem to be worried about that.
It's definitely something to keep an eye on. So let's switch gears and talk about what's happening here in the U.S. We're expecting some key inflation data this week, specifically the Consumer Price Index. That measure of the average change in prices that urban consumers pay for all sorts of goods and services.
This data is super important because it gives us a clearer picture of whether or not inflation's actually starting to cool down. Remember, the Federal Reserve's target inflation rate is 2%, but last December we saw it hit 2.9%. So everyone, from investors to policymakers, will be watching this week's data very closely.
And of course, all this is happening as Fed Chair Jerome Powell gets ready to testify before Congress.
His testimony is coming at a pretty crucial time, right after this new inflation data comes out. He's probably going to get grilled on the potential impact of Trump's tariffs on the economy, and also about his recent remarks on the U.S. national debt, which have caused a bit of a stir.
Right, because those tariffs could lead to higher prices for consumers, which would further fuel inflation. And then his comments about the national debt have some people worried about the long-term economic outlook.
Exactly. It'll be interesting to see how he addresses all these concerns during his testimony and what kind of signals he gives about the Fed's future policy decisions.
Okay, so let's shift gears again and talk about corporate earnings. We're over the hump of this earnings season, but we still have some big names left to report, like McDonald's, Coca-Cola, and Cisco Systems.
From the tech earnings we've seen so far, it looks like investments in artificial intelligence have been a major focus, especially after a low-cost AI model came out from a Chinese startup. A lot of analysts believe this AI trend will continue to drive growth in the tech sector.
And they're saying the next big market mover related to AI might be later this month when Nvidia, a major player in the AI space, reports its earnings. Their performance could give us more insight into where AI development and adoption are headed.
Now let's talk gold. Gold prices have been going crazy lately, hitting record highs. A lot of this surge is because investors are looking for safe haven assets amidst all this trade tension and economic uncertainty.
So basically, when things get uncertain, investors turn to gold to protect their money. It's seen as a safe bet, something that's held its value through all sorts of economic ups and downs.
Exactly. Gold is a tangible asset that tends to hold its value when other markets are going haywire. And the possibility of these trade wars escalating is definitely making investors nervous, pushing them towards gold to offset the risk.
But it's worth pointing out that gold's gains are being somewhat held back by a strong U.S. dollar. Investors are expecting interest rates to go up in the next few months, which could make the dollar even more attractive.
It's a bit of a push and pull, You have the uncertainty driving people toward gold, but then you have the strength of the U.S. dollar potentially limiting those gains. It'll be interesting to see how this plays out.
So the million-dollar question for investors is gold a good investment right now, or are the risks too high?
That's a tough one, and there's no easy answer. It really depends on your individual investment goals, your risk tolerance, and how your overall portfolio is structured.
Seems like there's a lot to think about when making investment decisions in this climate. The mix of trade tensions, inflation data, the Fed's actions, and even gold prices creates a pretty complicated web of risks and opportunities.
Absolutely. To navigate this successfully, you need to be doing your homework, making smart decisions, and be ready to adapt as the market changes.
Before we wrap up this part of our conversation, let's think about how these events might impact specific industries and even everyday consumer goods.
Good point. The tariffs, for example, example, could directly impact the prices of imported goods, which could mean consumers end up paying more. And industries that rely heavily on imported steel and aluminum, like construction and manufacturing, their costs could also go up, which could ultimately affect consumer prices.
So how would this affect how people shop? Could we see a shift towards buying more stuff made in the US, or maybe people will just spend less overall?
Both of those things could definitely happen. If the prices of imported goods shoot up, people might start looking for cheaper options, which would be good for companies that make things here in the US. But if prices in general go up too much, it could make people cut back on spending, and that wouldn't be good for economic growth.
It's a complicated situation,
Right.
and it'll be interesting to see how it all unfolds in the coming months. There's always a chance of unintended consequences when you mess with economic policies, and these tariffs are no exception.
Definitely. And we have to remember that these things aren't happening in a vacuum. The global economy is all interconnected, and what one country does can ripple out and affect the whole world.
We also have to think about how other countries might retaliate. If they decide to slap their own tariffs on U.S. goods in response to all this, it could spiral into a tit-for-tat trade war, and that wouldn't be good for anyone.
A trade war like that would disrupt global supply chains, drive up costs, and create a lot of uncertainty, which is never good for business or the economy in general.
All important things to keep in mind as we see how this all plays out. Before we move on, I just want to stress how important it is to stay informed and engaged with what's happening.
I agree. In a world that's changing so quickly, being financially literate is more important than ever. If we understand the forces that are driving the markets, we can make better decisions and navigate the challenges and opportunities that come our way.
It's a constant learning process, really.
One thing that's important to understand is that President Trump's whole approach to trade is based on this idea that the current trade deals are unfair to the U.S.
He's basically saying that these tariffs are needed to protect American industries and jobs from what he sees as unfair competition from other countries.
And by imposing these tariffs, he's trying to encourage companies to bring manufacturing back to the U.S. and to shrink that trade deficit.
But some critics are saying that these tariffs might actually backfire and end up hurting the U.S. economy in the long run.
Yeah, they're arguing that tariffs often lead to higher prices for consumers and businesses, which could slow down economic growth.
So it's kind of a tricky situation, and it's hard to say what the long-term effects will be.
Let's circle back to inflation for a minute. It's been a big concern lately, and for good reason.
Inflation really eats away at your purchasing power, making it harder for people to afford the things they need.
And it can lead to this upward spiral of rising prices and wages, which can destabilize the economy.
The Federal Reserve plays a crucial role in trying to manage inflation. They use interest rates to keep it in check.
Exactly. If inflation starts rising too quickly, the Fed might raise interest rates to cool things down.
Higher interest rates make it more expensive to borrow money, which can slow down economic activity and help control inflation.
But they have to be careful, because raising interest rates too aggressively can also have negative effects, like slowing down economic growth too much or even triggering a recession.
It's a tough balancing act for the Fed. They have to find that sweet spot between keeping inflation under control and making sure the economy keeps growing.
And the decisions they make have a huge impact on the markets and the entire economy.
All eyes will be on Jerome Powell when he testifies before Congress.
He's going to face some tough questions about inflation, interest rates, and how healthy the economy really is.
What he says could give us some valuable insight into what the Fed is thinking and what their plans are for the future.
It's a chance for him to lay out the Fed's message clearly to lawmakers and the public.
And hopefully reassure the markets that the Fed has things under control.
If we look at earnings, we've seen a mix of results this season.
Some companies have done better than expected, while others have fallen short.
It's a reflection of how complex and unpredictable the economic landscape is right now.
Businesses are facing all kinds of obstacles like rising costs, supply chain disruptions, and all the geopolitical uncertainty in the world.
All those factors are definitely impacting corporate profits.
But there's some bright spots too. Some sectors are actually doing quite well, and we're seeing innovation drive growth in certain areas.
Yeah, technology, healthcare, and renewable energy are a few examples of sectors that are showing resilience and potential.
It's important to remember that the stock market isn't the same thing as the economy. Earnings reports give us a glimpse into how companies are doing, but they don't tell the whole story.
Right. The stock market is influenced by all sorts of things, like how investors are feeling, global events, and even speculation.
It's constantly changing, and it can be pretty difficult to predict.
And that's what makes it so interesting.
Gold's been a hot topic lately, and for good reason.
Historically, it's been viewed as a safe safe haven asset, something that holds its value when times are uncertain.
Investors tend to flock to gold when they're worried about inflation, geopolitical risks, or when the markets are volatile.
It's a tangible asset that's maintained its value for centuries.
But gold doesn't generate income the way stocks or bonds do. It's more of a defensive strategy.
You're right. People invest in gold to preserve their capital, not necessarily to make huge returns.
So the question a lot of investors have is whether gold is a good investment at this particular moment.
Like most things in finance, the answer is it depends.
It depends on your individual investment goals, your risk tolerance, and how your overall portfolio is set up.
If you're looking for a safe haven asset to hedge against potential risks, gold could be a decent option.
But if you're after growth and income, there might be better alternatives out there.
The key is to do your research, understand the potential risks and rewards, and make an informed decision.
And don't forget about diversification.
Absolutely. Diversification is key for managing risk and reaching your financial goals.
As we wrap up this part of our conversation, it's clear that the financial markets are always in motion.
It's a dynamic and complex environment that requires us to stay alert and adjust our strategies as needed.
We've got to stay informed, engaged, and ahead of the curve.
By understanding the forces that shape the markets, we can make smarter decisions and navigate the challenges and opportunities that come our way.
That understanding can give us the power to make informed decisions.
Whether we're investors, business owners, or just engaged citizens, financial literacy is essential for navigating the world today.
Being financially literate lets us participate in the global economy, build our wealth, and secure our financial future.
It's a process of continuous learning and adapting to new information and challenges.
And that's really what we're trying to help you do here.
Exactly. We're going to keep exploring these topics, providing you with the insights you need to stay informed and make smart decisions.
But before we finish up today, I want to stress the importance of critical thinking.
Right. It's not enough to just passively take in information. We need to question our assumptions, consider different perspectives, and come to our own conclusions.
The financial world is full of noise and conflicting opinions. It can be overwhelming.
It's true, and that's why it's so important to learn how to filter through that noise and develop a solid framework for decision-making.
We really encourage you to continue researching these topics on your own. Don't just take our word for it.
Absolutely. Explore different sources, gather diverse viewpoints, and be open to challenging your own biases.
And remember, the financial markets are constantly evolving.
What worked in the past might not work today. You always have to be adapting.
It's all about staying adaptable, open-minded, and always willing to learn something new.
We hope this discussion has given you a better understanding of the key factors shaping the financial landscape this week.
We always appreciate you joining us for these explorations of the financial markets.
We'll be back next week with more insights and analysis, so be sure to tune in.
Until then, stay curious, stay informed, and stay invested in your financial well-being.